In the span of 48 hours, silver did something markets are not supposed to do in public. $96 an ounce, a number so violent it breaks normal expectations about what liquidity is supposed to mean. Not months, not weeks. In 2 trading days, the tape looked like a trap door opening under a crowded theater. They said this could never happen in a market this old, this institutional, this watched. Yet it did, and it did quickly enough to compress months of stress into a weekend's worth of decisions. And if you only watched the price, it looked like chaos. The first thing to move was the pressure. Because while most eyes were glued to the candle chart, the real shock traveled through the plumbing, a change that turns voluntary selling into mandatory selling, a change that doesn't care if someone has a thesis, only whether they can post collateral by a deadline. Institutions understand that layer because they live inside it. Most people meet it for the first time when it bites. Here's the pattern interrupt. After the plunge, the gatekeeper tightened the rules. On January 31st, 2026, CME raised margin requirements on COMEX precious metal futures. That single sentence explains why this wasn't just a drop. It was a sorting event. It separated those who could produce cash on demand from those who could not, and it did it at the exact moment volatility was already extreme. Welcome to Meridian Ledger, where we decode what matters before it becomes the story everyone repeats. This channel is built for viewers who want the filings, the flows, and the incentives, not just opinions. If you want calm, data-first analysis that connects market plumbing to price behavior, consider subscribing the way you'd keep a wise elder nearby. Not for noise, but for signal. And drop a comment with where you're watching from, because silver is global, and the clues often... Now let's reconstruct what actually happened with forensic detail. $96 an ounce, and the roughly 27% one-day drop hit a market that is not one market, but a stack of linked venues. Futures, options, ETFs, unallocated accounts, vaulted inventory reports, and the physical pipeline that feeds industry. When price moves, each layer reacts differently. Futures react in seconds, because they are built for leverage and speed. Physical reacts in schedules, because it has fabrication and delivery constraints. ETFs react in flows, because they translate public demand into a tradable wrapper. And during stress, those layers can send conflicting signals. The futures layer is where the leverage lives. A silver futures contract is not a bar of silver. It's a standardized promise. On COMEX, one contract represents 5,000 ounces. That detail matters because it turns an abstract chart into a real balance sheet. When a participant holds 10 contracts, they have exposure to 50,000 ounces. 100 contracts is 500,000 ounces. 1,000 contracts is 5,000 ounces. The price can move $1 and the P&L shifts by $5,000 per contract. This is where margin becomes the center of the story. The exchange and clearinghouse require a performance bond to hold that promise. If volatility rises, margin requirements often rise. Reports around the margin change for the March 2026 silver contract put the requirement around $25,000 per contract, after having been around $22,000 not long before, implying a roughly $3,000 increase. In a calm market, a $3,000 adjustment might look routine. In a cascading decline, it can be a collateral cliff. It forces immediate cash into the clearing system, not because someone wants drama, but because the system is designed to ensure obligations are met. Translate that into scale. One contract is 5,000 ounces. If someone is holding 100 contracts, a $3,000 margin increase is $300,000 of additional collateral demanded. If they are holding 1,000 contracts, it's $3 million. And that is only the incremental change. It comes on top of mark-to-market losses as price falls, because futures are settled daily. Margin hikes demand more cash. The same participant can be squeezed from both sides. There's another detail that makes this kind of move feel impossible. Margin doesn't just rise for the traders who are losing. That means participants who didn't panic still face higher carrying costs, even if their view hasn't changed. A hedger can be forced to reduce protection. A fund can be forced to cut exposure that was meant to offset risk elsewhere. And because futures prices anchor valuations, those reductions can spill into options, ETFs, and OTC, books that reference a benchmark. When participants reach for cash, bids thin, spreads widen, and a notice becomes a price event. So when you see a chart that looks like a waterfall, you have to ask a different question than most people ask. The common question is, who suddenly decided silver is worth less? The more revealing question is, who suddenly could not afford to hold their position under new collateral terms? That shift turns a market from a voting machine into a liquidation machine. The drop becomes less about belief and more about balance sheets. In the middle of a fast decline, they can amplify the decline by forcing liquidation at the worst possible time. The public narrative says margins protect the system. The price action reveals the side effect. The system protects itself by demanding cash from the weakest hands immediately. It makes it honest about its priorities. If this structure feels familiar, it should, because the pattern has appeared across decades. In 1980, silver became the stage for a famous squeeze attempt and an infamous collapse. The simplified story is about big players, but the functional lesson is about leverage and rule changes. When exchanges raised margins and tightened conditions, positions that looked unstoppable on paper became fragile in reality. The unwind wasn't a debate, it was arithmetic. In 2011, silver surged and then cracked in a sequence many traders still remember as a lesson in speed. Exchange advisories from late April 2011 show margin levels being adjusted, including in advisories that set speculative initial margin at $12,225 and maintenance at $9,500, effective after the close of April 26. Again, the exact numbers belong to that period's price level, but the logic is timeless. When volatility spikes and margin rises, leverage shrinks, sometimes violently. Price can fall faster than narratives can be written. And now, in 2026, the rhyme is visible. A sudden move, a margin response, a scramble for liquidity. The same structure repeating even as the headlines change. In 1980, a concentrated trade meant changing exchange conditions. Result, a rapid collapse and a lasting lesson about leverage. In 2011, a speculative surge met a margin ratchet. Result, liquidation cascades and a long hangover. In 2026, it's happening again, but with modern plumbing and more public paper pathways. Now we need to talk about the institutional movement, because this market is shaped by entities that don't show up in casual conversation. Start with CME and the clearing system, because it sets the collateral rules. It doesn't have to predict the market. It has to ensure that the promises made inside the market can be honored. When it raises margins after a plunge, it signals that volatility is now considered a higher risk environment. But it also creates a funnel. Cash flows toward the clearinghouse, positions flow out of weaker hands, and the price reflects that forced flow. Next, look at the large intermediaries, banks, dealers, and market makers that provide liquidity across venues. These entities can be long in one product and short in another, hedged on the surface, but advantaged in the plumbing. They can manage exposure through options, through forwards, through OTC agreements, and through inventory. They don't need to predict silver to benefit from turbulence. They benefit from spreads, from volatility pricing, and from being able to withstand a margin shock. That removes competitors who cannot fund the same risk. Then there's the retail-facing conduit that matters more than most people realize, the iShares Silver Trust, commonly known as SLV. This isn't a futures contract, but it is a massive public wrapper around silver exposure, 57%, 20 ounces held as of February 2nd, 2026. Those numbers tell you two things at once. The market shock was broad enough to hit the most visible public vehicle, and the public vehicle itself is a giant reservoir of exposure whose shares can move far faster than metal can. Now set that next to the physical reporting layer. $4 billion at the time. That is a mountain of metal by most standards. Yet it behaves nothing like a futures chart. Volt totals don't drop 20% in a day. They shift slowly because moving metal requires logistics, approvals, and real-world processes. This is where the dislocation begins. The paper world can reprice in seconds. The physical world reprices through friction. That friction can be a stabilizer in normal times and a source of stress in abnormal times. In a liquidation event, paper can be dumped at any price to meet a collateral call. Physical holders are not forced by margin in the same way. They may choose to hold, delay selling, or sell only at premiums that reflect scarcity in specific forms. And then there's the positioning snapshot that shows how large the paper layer is. CFTC data for January the 20th, 2026 in the COMEX silver category showed open interest of 244,012 contracts. Remember the unit, 5,000 ounces each. Multiply that, and you get notional exposure representing well over 1 billion ounces. The point is not to treat that as a literal claim on immediate delivery. The point is to understand how a market with that much paper exposure can become hypersensitive to collateral rules. When the biggest lever in the system is post more cash, the crowd inside of the market can be forced to move regardless of conviction. Now, let's put the contradiction on the table in simple terms. On one side, you have a futures market that can be hit by forced selling, amplified by margin, pushing price down rapidly. On the other side, you have physical inventories and industrial usage that cannot be liquidated at the same speed and cannot be manufactured instantly. That gap can appear as persistent premiums, delays, or regional differences, even while the headline price is collapsing. Think of paper silver as the ocean and physical silver as the harbor. When a storm hits the ocean, waves spike instantly. The harbor does not change depth in minutes, but the entrance can clog, the docks can strain, and the cost of getting in and out can rise. That is why you can see a futures chart collapsing while real-world procurement behaves differently. It's not because one side is imaginary and the other is real. It's because one side is a financing instrument and the other is a supply chain. Here's the cause and effect chain that makes this move make sense. First, a large leverage cohort holds futures exposure, either directional or as part of a hedge. Second, price drops fast, increasing daily mark-to-market losses and draining cash. Third, volatility rises, and the clearing system raises margin, demanding additional collateral per contract. Fourth, participants who cannot post the extra cash must reduce positions. Fifth, those forced reductions become market sell orders that push price lower, which increases losses for those still holding, which increases pressure for further liquidation. The loop can feed itself until the market finds a point where selling is exhausted or liquidity returns. In that loop, someone can be right about the long-term story and still be forced out in the short term. That is why margin events are feared by anyone who uses leverage. It is also why they are understood as a quiet form of power. Not power in the conspiracy sense, but power in the structural sense. If you control collateral rules, you control who gets to stay in the game during chaos. Now, let's talk about evidence beyond the chart because the numbers corroborate the mechanism. Start with the scale of open interest. 244 FARS, 12 contracts. Even if only a fraction of those are held by leveraged participants at any moment, the aggregate exposure is enormous. Now consider a margin level around $25,000 per contract. If a large share of open interest must be supported with collateral near that level, the collateral involved quickly becomes a multi-billion-dollar reality. That's why margin changes matter. They don't touch sentiment first, they touch cash. Then consider the ETF data as a window into public exposure. 57% in a major trust shows the shock was not isolated to a thin corner. It hit the broad perception layer. 20 ounces show how much exposure is concentrated in a vehicle whose shares can be traded instantly, even when physical sourcing is slow. That mismatch can become significant when creation and redemption flows accelerate, because the wrapper is liquid and the underlying has constraints. Now consider the vault reporting layer. 27 soothed and 818 tons in London at end December 2025. That number is huge, but it is also a snapshot with caveats. Not all vaulted metal is available for sale at the screen price. Some is allocated, some is held for specific purposes, some is part of financing structures. In stress events, what matters is not the total number. It's the free float at the margin. That is why prices can move violently even when total inventory looks large. The marginal buyer and seller set the price, not the warehouse total. This is the part where many narratives fail. People assume that if inventory exists, price cannot move, but markets do not clear on totals. They clear on willingness to transact at the margin. 1 million ounces sitting quietly in a vault does not prevent a futures contract from dumping in response to a collateral call. A refinery that needs a specific form of silver does not care that there are tons somewhere else if delivery timing and form are wrong. These frictions are not exotic, they are normal. The question is whether stress makes them visible. So how is this executed mechanically in a way that feels like a coordinated blow, even if it is simply the system reacting? The core tool is the margin requirement. Think of margin as the security deposit on a promise. If the deposit suddenly increases, the same promise becomes more expensive to hold. Now add the fact that futures are marked to market daily, so losses are realized immediately in the form of cash debits. It's like paying rent daily instead of monthly. When the bill spikes, cash flow becomes the battleground. A useful analogy is a busy bridge during rush hour. Everyone is already on the bridge. Traffic is heavy, but moving. Then the operator announces that the toll has risen and must be paid immediately by everyone currently on the bridge. Some drivers have cash, some don't. The ones who don't must exit at the next ramp, even if that exit is crowded and inconvenient. As they try to exit, they slow the lane and create jams. The jam isn't proof the bridge is weak. It's proof the toll policy changed mid-crossing. That is why the timing matters. A margin hike after a plunge hits participants when they are most stressed. Their cash buffers are already depleted by losses. Their risk models are already flashing. A collateral increase at that moment forces decisions that would not be forced at a calmer time. This is why the move feels terrifying to investors watching from the outside. It suggests that the market can be pushed into a cascade by changes in financing conditions, even if long-term demand and supply have not suddenly changed overnight. Again, this isn't about attributing motives to individuals. It's about acknowledging incentives. A clearing system is designed to reduce the chance of default. When volatility rises, it raises the required bond. That is rational risk management. The side effect is forced liquidation. Both things can be true at once. The system can be acting to protect itself and simultaneously creating a deeper price shock for participants who cannot meet the new cash demand. Now, what does this mean next historically? After forced liquidation cascades, markets typically move into one of three regimes. In the conservative regime, volatility cools as leverage is flushed out and open interest declines. Price stabilizes at a lower range. and the story shifts from panic to rebuilding. In the moderate regime, the flush creates a vacuum, and price snaps back sharply as forced selling exhausts, because there are fewer sellers left once the collateral sorting is done. In the aggressive regime, stress migrates from paper into physical channels and dislocations deepen, showing up as persistent gaps between benchmark pricing and real-world availability. None of these outcomes is guaranteed. The point is that the pattern is consistent. Collateral shocks compress time. They force the market to do in days what it might otherwise do in months. That is why these events are so memorable. They do not feel like normal discovery. They feel like a circuit breaker that never quite trips, just squeezes. So what should be watched specifically if you want to understand the next chapter without guessing? Watch margin requirement notices and contract rule updates because they determine who can hold leverage. Watch open interest in the futures complex because it reveals how crowded the promise layer remains. Watch volatility measures in precious metals because they feed directly into risk controls. Watch ETF share creation and redemption patterns because they reveal whether public exposure is expanding or contracting. Watch vault data for sustained trends, not daily drama, and watch for persistent differences between paper pricing and physical sourcing signals because that is where stress leaves fingerprints. Finally, understand the divide this creates. In every major market stress event, there are two groups. The difference is not IQ, it is attention to structure. One group watches price and assumes price is the entire truth. The other watches the rules and the financing that shape how price is formed. The second group expects the strange behavior because they understand the machinery. The wealth gap in markets often mirrors the information gap. Institutions don't always have better predictions. They have better access to structure, to financing, to clearing relationships, and to the ability to act before a forced event becomes obvious. Retail tends to move last, not because retail is slow, but because retail is shown the story through the loudest channel, which is the chart. The chart is the output, not the input. The grounded answer is that the system pulled the lever that matters most in a leveraged market, collateral. It turned a price decline into a liquidity test. It forced a sorting process, separating those who could post cash from those who could not. And it did it at a moment when volatility was already extreme, ensuring the effect would be dramatic. If that feels unsettling, it's because it reveals something deeper than silver. It reveals how modern markets function. The headline price is a surface. Underneath it are contracts, clearinghouses, balance sheets, and rule changes that can transform a trade from manageable to fatal in a single notice. Most people don't track that layer. Institutions do, because they have to. And once you see that, you stop treating these moves as mysteries and start treating them as patterns. This is Meridian Ledger, where we decode what matters before it becomes headlines. If this connected dots you hadn't seen, you know what to do. The question isn't whether volatility returns to commodities over time. The question is whether, the next time the collateral lever moves, you will recognize it for what it is before the chart tells the story.